Hello everybody, and thank you for joining us today for our equity webinar. This will be a review of our equity views from Q1. With me today on the panel is Romelon, Equity Portfolio Manager, Seeiso, Head of Equities, and Bastian, our Chief Investment Officer. Welcome gentlemen, and thanks for joining me today.
Yeah, thanks Mario.
Bastian, obviously to start we really need to look at the global macro position, and as usual I'd like to ask you to give us a reflection on where we see global markets.
Yeah, thanks Murray, and thanks once again to everybody for joining. So not too much change from our view as of recent, Murray. We had some weaker data prints over the last couple of weeks, but overall our story stays the same. Positive global growth driven by a positive US economy, and the data actually, other than the last one or two prints, continues to surprise on the upside. So the two line charts we are showing is in the dark blue, the real GDP prints which we have observed historically, and in the light blue we've got the present economic indicators, so our in-house point forecast. And if we move into the more recent history, basically focusing on the right-hand side of the chart, you can see two things. First of all, we've never been predicting a recession to be around the corner over the last 2 years, which happened to come true. And then if you look at the right-hand side, we're still expecting a print of 3.06% real GDP growth in the States as we speak. So a lot of positive growth, still upside surprises compared to what economists or market participants are expecting. And with that, a sustained strong economy in the States. Okay, so what these charts suggest is 3% real growth. And the interesting thing which I want to highlight, because we get a lot of questions on that, is that already includes the more recent labor market report, which actually surprised on the downside, where we've got lower quits rates, lower hiring rates, less job openings. All of that is already included. So in a nutshell, there are cracks emerging. We're not saying that this 3% real growth is going to carry on for good, but the reality is, as we speak, it's still a very strong picture in terms of global growth, and especially led by US growth.
Bastian, that's almost counterintuitive in that everything still seems very inflationary, yet markets are reacting on what we would think is bad news. So on a rate front, we know that we expected rates to come down maybe soon in this year, but the Fed seems to continue to say rates higher for longer. Maybe just a comment on where we see and what the number of potential rates could be this year.
Yeah, 100%. I want to first go to inflation to speak about that, because the crucial thing to understand is, yes, the global economy and the US economy in particular is going strong, and yes, that potentially enables the Fed to keep rates higher for longer, as we say. We don't think that's our base case though, because the reality is that inflation keeps on coming down, and if one understands the dynamics behind inflation and why it's actually not as sticky as it might appear, then there will be room for rate cuts later this year. So what we're showing on this chart is just the top line number of the US CPI year-on-year rate of change, so the CPI print, so to say. And if we zoom into the more recent history, you can see on the right-hand side we've got that spike all the way up to 9.1 June 2022. Since then we have seen a steep reversion of inflation coming down quickly. What we have now almost experienced for, I think 11 months now, that small area on the right-hand side, which is a slowdown in the deflationary process, which leads people to call inflation more sticky. We think it's important to really look a little bit deeper under the hood, and if you do that, you can see that the current makeup of that last inflation print is really driven by almost just one element, which is a shelter component. And obviously we've done a lot of work to analyze this shelter component into the last detail, and our indicators suggest that this shelter component will come down quite rapidly over the next 6 to 12 months. Okay, and that inflation view is often actually seen as quite too optimistic, so driven by the shelter component coming down. Often we get the question, how are you so sure that the shelter component will come down and drive inflation lower over the, let's call it, next 6 to 12 months? And the reality is that shelter is actually quite predictable. So we've got a simple model where we basically just use wage growth, where we use house prices, and where we use new tenant rents, and we can actually explain more than 90% of the variation of the shelter component. And what that analysis suggests is that over the last 4 or 5 months, where once again we had upside surprises on inflation, purely driven by outliers within the shelter component. So if we just need a little bit of reversion to the mean, we'll immediately have lower inflation, and that will open the door for rate cuts potentially later this year, or at least early next year.
Thanks, Bastian. So we know that rates are higher. I mean, basically we've seen very strong growth, labor market strong, etc. But I mean, at some level, the consumer needs to feel, relief through rate cuts. So just give us a view on the expectation in terms of the rate cuts and what that'll do for markets.
Okay, so I think that's exactly the point, right? So we've started the year assuming 6 cuts. We have repriced to now assuming just 1 cut. So the Fed has been hawkish, the market has reacted, less cuts priced, kind of like negative for the consumer, negative for asset classes. But we do think that that story will change potentially latest early next year. So what we can see in the red line on this chart is basically the current effective Fed fund rate. So that sits at 5.4, exactly the target of 5.25 to 5.5, which the Fed is trying to achieve. And then in the blue line, we've got the market pricing into the future. So today we're at 5.33, that's roughly where interest rates are. And then if we move out all the way until December 2024, you can see that we are only roughly 30 basis points, i.e. 1 cut lower. So that's how we've moved to just 1 cut. And even into the future, the pathway of lower interest rates is very shallow. If we compare that to how the story looked 6 months ago, you can see in that grayish line that obviously interest rates were much lower, were priced to come down quicker, and were priced to stay lower for longer, and we had a change to that view by market participants. What is the Fed doing? The Fed is telling us, that similar story to what the market is assuming, but actually a slightly more dovish stance. The Fed is telling us interest rates will come down. They will just come down very, very slowly. So all of this points us to a kind of like hawkish view compared to where we've been 12 months ago, but I do think it's important to consider the bigger picture.
Bastian, looking at what you've shown, as well as we know out there that certainly there are elements of the US consumer that are feeling the pinch. I mean, we know that goods are expensive. The cost of living in America has risen. I guess it's the shelter piece that you've spoken about. So there are headwinds for equities. Yet we see this market continue. Maybe just describe what those headwinds are and where we see this playing out.
So I mean, for me too, and I guess Seeiso and Romeo will go way more into detail to explain those headwinds. But I do think, just finishing off on the interest rate cycle and where we're at, the reality is that we have seen interest rates moving higher in terms of pricing when the Fed cuts will occur. So that has been hawkish. We've seen a more hawkish tone by the Fed. So we've had those negative surprises, almost shocks on the equity market, yet the market has been resilient. But forget about the market for a moment, just looking into the future, what's going to happen now? So we've set ourselves up for actually quite hawkish pricing, yet we have an inflation outlook, which at least our inflation outlook at present suggests that there could be downside surprises on inflation. So downside meaning lower prints than expected. And if any of that to some degree comes true, there will be room for a more dovish stance, and that will be supportive for equity, supportive for the consumer. So with that, we potentially have engineered almost like the soft landing which we were all hoping for, with an economy which has never really slowed dramatically, but interest rates now actually at a point where they could come lower.
Okay, thanks very much. I mean, it's very interesting if you turn to an equity market point of view now. I'm saying there are these headwinds, consumers under pressure, high rates, cost of capital is expensive, yet earnings have, as we've seen, been reported recently, are still very strong. I mean, how does this work out? So can you give us insight into the US market?
Yes, no, definitely. And thanks, Murray, thanks everyone. So quite rightly, we've seen earnings actually, we've just gone through an earnings season now in Q1, and earnings have come out quite decent. Particularly in the US, and I think part of that is that there is this very strong consumerism in the US. So if you look at the labor markets, for instance, they are still incredibly tight, which means that people are finding jobs, which means people have funds to spend, and with the big consumerism culture, that obviously feeds through into corporate earnings and has supported earnings. But if you look at valuations, which I think is a big headwind if you look at US equities, we're still sitting at really high elevated valuations. You look at the S&P 500 index, for instance, it's highly concentrated at the moment, and a part of that, it begs a question as to whether or not the increase in price is justified by the earnings growth. And in our view, not so much. And I think what we've seen is obviously the resurgence of the tech sector, which has driven most of those earnings there. There's actually a very nice decomposition that shows that if you strip out the impact of the tech sector, the Magnificent Seven, if you will, then the S&P 500 performance has actually not been as outstanding as it seems. And then you can contrast that with emerging markets. So if you look at the emerging markets, so there's also valuation headwinds there, but of course you couple that with the issues around China and then the general geopolitical climate, then emerging markets also are seemingly facing a difficult time. But I think given the fact that we are poised for a dovish outlook, then we obviously have that carry trade. If rates start to go down in the US, money seeking high-risk assets feeding into emerging markets, and locally with our very good valuation story, then it makes a really good positive story for equity markets. Okay, so if we look at our asset class views and we zoom in particularly into US equities, speaking of those headwinds being particularly valuations, with the S&P running at incredibly high valuations, you can see that all the valuation scores are quite negative for the US, and the sentiment is the only factor that's actually quite positive. Financial conditions and economics are pretty much neutral. And then if we contrast that with EM equities, we can see a similar picture where valuations are also negative with sentiment positive, and locally where we have a neutral view, quite the opposite picture, where we have valuations quite strong. So a South African market trading at pretty good, attractive valuations. However, we are quite negative on the sentiment, financial conditions, and economics factors. Yeah, so as we've seen, there's definitely some headwinds, but I think on the local side, the valuations is really the factor that's going for us, and if we just need to get our sentiment right, and of course that comes with a big risk event that we have to get through at the end of this month.
Okay, thanks, Seeiso. Romelon, bring that all together in terms of what actually played out in the quarter. So from maybe a developed markets, emerging markets, how did things play out?
So Murray, thanks for the question. As we all know, global markets, or the markets in general, don't behave exactly how we expect, and whatever outlooks we have and expectations normally don't really play out that way. So coming into 2024, there was an expectation for investors to pile into risk assets such as equities, and there was this bullish view coming in the back of last year where equities performed well in the last quarter of 2023, and coming into 2024, we expected rates to be cut a little bit more aggressively given the high hiking cycle last year, and with that the rates were expected to be cut when inflation came down, moderated a bit. But what we've seen is that inflation has remained higher than expected, and central banks have put a hold on rate cuts and have deferred them to potentially later in the year. And given that, the developed markets have outperformed the emerging market counterparts. Well, equities is viewed as a risky asset class, and within that risky asset class, the less risky equities were preferred. So the overall market, the MSCI All Country World Index, had performed 8.2% for the quarter, largely driven by the developed markets MSCI World Index, which did 8.9%, where emerging markets have lagged quite significantly, doing 2.6%. And as Seeiso mentioned, that was largely driven by the US economy, strong labor market, strong consumer spending, and the Magnificent Seven that you mentioned drove that return higher. The other developed market country that did well was Japan. Performance was strong there as well. The UK underperformed relative to the US, and what we've seen is that the large portion of the developed market return has been driven by the strong US economy. coming closer to emerging markets in South Africa specifically, the South African market in general was down for the year, given the pause on rate hikes, rate cuts, sorry, and the market delivered a negative 2.3%, largely driven by a poor performance from financial sectors, yet to print a positive print, a monthly print in 2024, down 7.6%.
Romelon, thanks for that. I think, if we bring this back to an investor discussion, so I think we've articulated pretty well how we see the world, what's happened, but really I think where we sit and we talk to clients is about what next, what's coming, and I think that's the big decision or call that people have to make, because it's really an allocation of capital, whether it's domestically or internationally. I think on both fronts we know from a historical perspective, obviously, is that people want equity exposure for the potential higher returns, but given these headwinds that we've spoken about and the high rates, it's obviously a concern that equities would be under pressure under these circumstances. Okay, so from an asset allocation perspective, from a global point of view, talking about whether you allocate to equities in the developed market or into emerging markets, there are some valuation opportunities that are coming out. Maybe you want to add to that, and where does one go from here?
Yeah, thanks, Murray. I think that's a very important point to actually hammer on. So once allocators have made the allocation decision to equities, because of whatever factors, what we have to ensure is that they get the benefit of that particular asset class. And unfortunately, what we've seen is that a lot of value can be destroyed, even though allocators have gotten the call right to invest in equities based on whatever factors at the right time. They can get quite a lot of value destroyed if they go all the way down to stock picking errors, etc. And a lot of work has been done that shows that most of the asset class returns can be attributed mostly to getting the macro right, getting the geography right, and then getting the asset allocation right. So I would like to show this work that we've done that highlights just how important it is to get the asset allocation right. All right, so as we're saying, it is quite important to get the benefit of the equity market performance once allocators have made the call to invest in the equity market. And as part of our investment philosophy, we often show this chart, which shows the percentage of underperformers and outperformers of the JSE All-Share Index or any other index for that matter across various time periods. And what this highlights is that often allocators can lose out on the benefit of getting the asset allocation correct due to bad stock picking because over a 3-year period in the Seeiso General Equity category, as this chart shows, 74% roughly of all those managers underperform the JSE All-Share Index, and only 30% or so outperform over a 3-year. And if we move this out to over a 5-year period, the numbers are more drastic, whereby 83% or 80.3% underperform and only 19% or so outperform. Hence, showing the importance of getting the investment philosophy right once you've gotten the asset allocation right.
Seeiso, thanks for that. I think what you've done really is make the case for equity allocation, but within that, equity selection is then fund composition is important.
Correct.
And I know what you're doing here. You've shown the data, we know it, but how do you do it?
Yeah, thanks, Murray. That was actually a segue into that question, hopefully. So the idea there actually is just again to highlight the importance of having a cognizance of the overall market performance when building these portfolios. Again, not wanting to sound like a broken record here, the idea being to protect the investors from the possibility of not getting the benefit of the equity market exposure even though they got the equity allocation call right. So within our portfolio construction process, we are very much cognizant of the benchmarks, and we're very much cognizant of the overall equity market performance, or beta, in constructing these portfolios. And to that end, we have this allocation currently as the most representative of the equity market performance. Okay, so to ensure that our clients and allocators to equities get the full benefit of the equity market, we allocate based on sectors, and this is our current sector allocation. So we're mostly allocated in financials, basic materials, and technology. And the great thing is that we can actually drill down into the share level and look at our asset allocation or sector allocation through time for better insights.
Okay, that's great. Thanks, Seeiso. So basically, what we've got here is, let's just say there's a allocator making a call to invest in domestic equities. From a prescient systematic process point of view, what you've shown is you will give the client the domestic equity allocation, and even down to sector level, you've shown that historically, the systematic way we do things, you're able to deliver a better than market performance or better beta performance. But now this sounds like a little bit of indexation to me. Is that the case, Romelon?
Yes, it is. It's not passive indexation, it is enhanced indexation, which means that at the end of the day, the way to view the prescient equity portfolios is they are equity portfolios. And what you're going to get as an investor is, at the very least, the benchmark return. And by enhanced, what we do is we target to give you a performance that is above the benchmark, and that being 0.5% or 1% more than the benchmark, but consistently. The important thing is that it's consistent over the long term, because when you invest in equity funds, you are investing long term. And people ask us how do you compare to passive? Well, a passive indexation at best can do you the index return less fees, and over time, with compounding those fees, you will systematically underperform the benchmark. So what we do is, we're giving you the benchmark return, call it, if the SA equity benchmark does 10%, you will get that plus some. And over time, that compounding allows us to outperform even the active managers, who in a single year could do plus 5%, but in another year do minus 5%. But that consistency over time is what allows us to outperform.
Great. Okay, so I was smiling as you said fees. I mean, that's always a consideration. And I think what we do appreciate is that the cost of equity funds is the one big factor that detracts from that performance. So investors make the right decision, there's an allocation to equities, but unfortunately, even if the stock selection is right, the fee deteriorates the performance. And unfortunately, we can show, and it's proven through much literature, is that way is you get this equity underperformance. So what we're trying to do here from the process is deliver an in-line with benchmark, and the outperformance comes from two things. One, you've spoken about a portable alpha element, which is in addition to the index return, as well as, obviously the point here is, at a reduced fee. And I think that's the incredible piece, that over time, what you're not doing is taking away from the client's investment by charging a large fee. So Seeiso, maybe just from a pricing perspective, talk to our equity funds and what is the pricing on these?
Yeah, exactly. You hit the nail on the head there. So I think the important consideration here is that, of course, any fee that is levied on the fund is indirectly passed on to the consumer. So if one of the easiest way to manufacture good performance is actually to lower the fee. And depending on how you manage portfolios, it will actually determine what sort of fee you can charge. And the way we do it is we are reasonably priced. I mean, we're giving active-like performance, with superior stability, consistent stability, at a management fee of around 30 basis points on a retail fee class, which is very well priced if you compare to other active funds. And then the performance sort of speaks for itself. So if you look at our performance on a 3-year basis for our Prescient Core All-Share Equity Fund, so this is the A2 fee class, so the retail fee class. This is essentially the ranking relative to every other fund in the Seeiso General Equity category. You can see that for the majority of the time, the fund is either in the first and the top quartile, which is actually quite incredible. And if you look at that through time, it's even more impressive. So this chart shows over 3 months, 6 months, 1 year, and so on, the percentage of time that the fund has spent in each of the quartiles. And incredibly, if you look at over 4 year and over 3 year, we're actually never in the bottom quartile, or even or just a little bit in the third quartile. That's quite incredible and speaks to the consistency of that outperformance in this product.
Thanks, Seeiso. That's very impressive consistency. And I think that's what we're talking about here, and why somebody would want to consider this fund. Bastian, is it the time to be investing in domestic equities in a product like this?
Well, I guess so, yeah. The numbers speak for themselves. But I think it's because of that always a good time to move into enhanced indexation, because you're constantly saving costs. Always a good time to save costs. Always a good time to outperform the passives. Always a good time to outperform the active. So that's what this product does. But I do think that if you really look one step deeper and ask yourself, what are the alpha drivers of the strategy? The challenges and the headwinds, despite their quite impressive performance over the last 2 years, have been these high inflation prints and the strong headwinds from ever higher interest rates. We passed that now. Okay, so who knows when we're going to cut rates? We think rather sooner than what the market thinks. But even if we stay at that level, or if rates come down, we're not going to see higher rates from here. And with that, there is a natural tailwind to this strategy. So while I'm confident saying that it's always a good time to use the strategy, right now it is actually an even better time than in other periods.
Great. Thanks, guys. To wrap it up really, before we hit our time and get to questions, the point that you made now, I think from an allocation perspective, and we can talk about people that construct portfolios, asset allocators, for example, would want to get an equity exposure. This is a great option. I think the point we make here is not necessarily that you shouldn't be supporting active equity funds. There is a place for them, because alpha generators through stock selection over time, although very few, we know that they exist and they have a benefit in a portfolio. But this component of our equity construction process could place as a core to a portfolio at a very extremely well priced point as well, which is a benefit to the portfolio. So we think the place is really around whether you're going to allocate to equities, or even if you're building up a balanced fund, Regulation 28 compliant, and the South African equity exposure is required. This is a great place to be as a core and satellite component. As I say, we're not saying there's no place for active, but we think through the systematic equity process that we've delivered, the proof's in the pudding, you've shown it, is that there is consistency, and ultimately, the benefit of that is to the client portfolio, and at a reasonable price. So, folks, we'll cut it there. Thanks for joining us. As I said, we'll go to questions, but again, thanks to the panelists for joining. Please look out for us. Our business development managers have the detail that you require. Please view our website for the fund fact sheets. And also please look out for our Prescient On Point, which is our new quarterly newsletter with our investment professionals' insights and views. Thanks for joining us.
Yeah, we've got quite a few questions. I'll try to moderate that a little bit. So first question is, with the upcoming index harmonization of Swiss and Aussie, how are we going to be impacted when we look at our product range, and what are we going to do about it? Yeah. Maybe for you, Seeiso.
Yeah, I think I'll take that one. I mean, the index harmonization has been it's been talked about for a long time, and now it's done. It happened in March. I think the thing is, at Prescient, we've always made sure that we have a product. We have a retail product for each index, still running the exact same strategy. And I think going forward, with the harmonization, we will ensure that our product range still, has a product for each index that's available. So nothing from a investor standpoint. Investors will still be able to get the exposure to whatever index that is that they require.
Thanks, Seeiso. Next question: the potential BHP takeover of Anglo American. This has been viewed as negative for SA equities, because BHP seemingly doesn't want to take over SA assets from Anglos. Do you have a view on that?
I will reluctantly take this one, I must say. So I think our process makes it very deliberate. We're very deliberate that we don't take stock-specific views, but of course we monitor and follow all events that happen in the equity market. And this BHP takeover Anglos actually happened after the end of Q1, but still the reasoning behind it is important to understand why it's not so much
a view on SA equity. So BHP, for what we understand, simply is going for the copper assets of Anglo American, and I think there is this whole view on copper being a future-facing mineral, and mining companies have strategically wanted to get ahead of this, which is simply what BHP is trying to do. The controversy comes with the exclusion of the SA-specific assets, like Kumba and Amplats, but I think given what BHP's objective is, this actually certainly makes sense, and it's not, in our view, a reflection of any negative sentiment towards the SA equity market. And maybe the one last thing I'd say there is that this is quite a complex deal, and it's likely to be a drawn-out process. There's a lot of jurisdictions involved. There'll be antitrust regulators which will play a pivotal role in it, but definitely not a reflection on, I think, or we think, not on the SA market.
Thanks, Seeiso. Next one is a bit more broader, quite general. How does your enhanced indexation process differ from simple passive indexation?
I'll take that one, Basti. I think the best place to start is with what is simple passive indexation. And that is just replicating what each of the shares weights are in the overall index by going out and buying each of those shares in those proportions. And what we know is that over time, if you take this approach, after fees and other costs, the performance of the portfolio will be under the benchmark consistently. And as that compounds over time, you can have a large systematic underperformance. So if you want to be fairly certain of the benchmark return, and when you want to get alpha above that, enhanced indexation is the way to go. And we know there are big players out in the market that do this apart from us. Players like BlackRock use script lending to obtain alpha above the benchmark. Here at Prescient, we believe in using the cash and money market asset class as a way to generate a return that's higher than the benchmark. We know that achieving alpha in the cash and money market asset class is a lot easier than taking specific stock-specific asset calls. And we're very confident in this approach because we have expertise across the floor on how to optimally achieve a portfolio that can beat any equity benchmark. And when you see the equity team at Prescient, you should know that it's backed by a larger team that works on achieving this optimal portfolio.
Great, thank you, Romeo. And the next one, I think it slots in quite nicely with that, also quite broad. You mentioned that it's a good time to invest in equities because of the dovish interest rate outlook. How do you reconcile the two to get that conclusion? Given that I said that, I will actually answer that question myself. So I guess it's important to understand that our core equity strategy has a beta and an alpha element, and both of these elements basically benefit from interest rates coming down. Okay, so if we have some degree of certainty that we're at the peak of the hiking cycle, which we certainly have, then that should be supportive for equities in general, because you see interest rates eventually moving down. With growth still being supportive, you kind of have like a Goldilocks scenario, which is generally very good for equities. So that's going to support our beta case. And our alpha is also driven by interest rates because, as Romeo explained, we are porting fixed income alpha on top of our equity beta. So you're getting fixed income alpha on top of equity beta. Your fixed income alpha is generally better when interest rates are high and have a trajectory to potentially come down. So even if interest rates come down slower than expected, and even if rates stay higher for longer, which is not our core scenario, but if that would happen, we would still benefit with our core equity strategy, because high interest rates with the risk of potentially coming down, it's exactly when the strategy does best. Okay, so I hope I answered that one.
Yeah.
Next question. You mentioned that South Africa has valuations going for it, but sentiment is detracting ahead of the elections. What do you look at when you talk about sentiment, and what makes you think elections could lead to a potential uplift?
Yeah, so I think that I mentioned that one, so I'll take it. So yeah, we saw in the video earlier. So if you look at the factors that we look at when we make our asset class views, valuations was very good on South African equities, but sentiment was not. And when we think about sentiment, we essentially can put it into three categories. So we look at business sentiment, we look at consumer sentiment, and investor sentiment. And I think the biggest detractor from that sentiment view is probably the investor sentiment. So the South African equity market is to a large extent driven by foreign investors. I mean, this is a pretty well-known fact. And for the most part, during the quarter, that activity from foreigners has been pretty much muted. And yeah, I mean, we have these elections coming up, which is a big risk event and leading to a lot of uncertainty. And I think given the importance of these particular elections, it doesn't seem at least as clear-cut as of the outcome as it has been in the past. There is quite a lot of policy uncertainty, and I think particularly on the fiscal policy, so that's government spending, and what's going to happen at National Treasury. We've already seen a bit of policy uncertainty on the monetary side, but that's of course a completely separate issue, luckily. But markets hate uncertainty, so any reduction in uncertainty and any sort of clarity as to the way forward will obviously have an uplift on general sentiment. So that's the point I was making there. So regardless of the outcome, the mere fact that we do get past this election, we do get past this risk event, and this cloud of uncertainty to some extent lifts, markets can start to recalibrate, investors can start to recalibrate, and hopefully that leads to potential uplift for the equity market.
All right, thank you, Seeiso. And there's another question. We know how global equities performed from a top-down view. And we also saw large moves in commodities, particularly a spike in the gold price. What has this meant for investors?
I'll take that one. So there's been so much talk about the Magnificent Seven, but commodities have been doing quite a bit of movement this year. So gold prices have soared to the all-time highs. I think it was the 9th of April. And South Africa being one of the largest producers of gold, it's quite an important thing for South African investors. And the question that investors have to answer is, how do we get gold exposure? Do we go and buy it physically? Do we buy an ETF that tracks it, or do we go into gold mining companies? And gold has always been viewed as a safe haven whenever there's uncertain market conditions, and with the Fed putting hold on interest rate cuts, the investors have flocked to gold exposure, and that has put the prices through the roof. And so one would think that if you go and invest in a gold mining company, the price should move one for one with the price of gold. And that's not necessarily true, because there are a lot of more other factors at play, such as currency, production costs, market sentiment, financial leverage. And just taking currency, for example, we have companies like Harmony Gold and Gold Fields in South Africa, and they sell their commodities in dollars, and they are exposed to the South African rand versus dollar currency. So if the rand weakens, their revenue automatically goes up because they're selling in dollars. And even if the price of gold stays constant, so you can't solely rely on the price of gold to make your call on gold mining companies. And I think it's important to note that there are a plethora of factors that affect gold mining companies before taking the decision to get gold exposure.
Yeah, that's very interesting. Maybe next time we can look into these factors. That would be very interesting. We're kind of out of time. There's a few more questions, but I think we'll leave it at that. Thanks everyone for joining, and yeah, hopefully join us again for the next couple of webinars. Thank you.